I'm looking at the data right now and something doesn't add up. Gold is up. Silver is bleeding. China's largest e-commerce platform crashed under the weight of a gold-buying stampede. Physical bars sold out across retail stores in the world's most populous nation. And while all of that was happening, Western spot silver got slammed nearly 8% from its highs in under 2 hours, right before New York opened for business. Those two realities cannot coexist without a reason, and the reason is the entire video. My name is OG John AG, one handle, OG John AG 2.0 on YouTube. Everything else is imitation. They can copy the format. They cannot copy the data, the track record, or the skin in the game. The only thing you need to verify is the handle. If you're here for the first time and you've been watching this space trying to make sense of why prices are doing what they're doing while the world is literally on fire, this channel is built for exactly that. Hit subscribe not because I'm asking you to click a button, but because what I'm about to walk you through in the next 12 minutes is the kind of analysis you will not find anywhere else, and you are going to want to be here when the follow-up drops. Last video, I told you to watch the gap. I told you Kinesis Silver was trading near 100 over the weekend, Hyperliquid at 96, PXG Gold at 5,400, all while Western Spot closed Friday at 93 on silver and 5,278 on gold. Physical-backed crypto markets running all weekend, providing real-time price discovery while COMEX was dark. I said those premiums were your preview of what Monday would look like when institutional hands came back to their desks. And that's exactly what was printed. Silver gapped from 93 to nearly 97. Gold punched above 5,400 at the open. The premium told you before the open. It always does, if you know where to look. But here's where today becomes more important than the gap itself. Silver is now sitting at 90, gold is at 5,346. And the path that got us here, the reversal, the divergence, the forces that created it, that is the entire video. Because what played out this morning isn't just a price move. It's a masterclass in understanding how different regimes create different market leaders, and why the crowd is almost always positioned for the wrong version of the trade at exactly the wrong time. Pull up a live feed right now while you're watching this. Look at Chinese gold mining stocks. Every single major Chinese gold miner is sitting at the daily limit up. Then look at Western mining stocks. Now tell me what you see. Because the divergence between those two groups in the same sector, on the same underlying asset, during the same geopolitical event, is one of the most important data points in today's market. And if you understand what it means, you are already ahead of 95% of the people trading precious metals right now. Let's start in China, because while American traders were drinking their coffee and waiting for New York to open, China was already in a full-scale physical gold buying frenzy, the likes of which I have not seen reported with this level of detail anywhere in Western financial media. China's largest e-commerce platform adjusted its gold pricing to the equivalent of 5,574 per ounce this morning. That number alone is staggering. Western Spot was sitting at 5,346 as I recorded this video. The gap between those two numbers is already enormous. But then something happened that completely reframed even that premium. Physical supply started running out. Major physical gold retail stores across China stopped selling investment gold bars entirely. Not slowed down, stopped. The only gold available for purchase at those locations right now is craft gold, decorative pieces, jewelry-style bars, not the investment-grade products that Chinese savers have been piling into for months. And the price on those craft bars, the equivalent of 6,229 per ounce. Let that number sit for a moment. 6,329. Western Spot is at 5,146. That is roughly a $1,000 premium on physical gold in Chinese retail stores. Not because of a pricing algorithm, not because of currency conversion quirks, but because investment bars are gone. Sold out. Physically unavailable. The shelves are empty. This is not a technical divergence on a chart. This is physical scarcity materializing in real time in the world's single largest gold-consuming nation. And then the platform itself gave out. Jingdong Finance, running gold accumulation products in partnership with Jiashang Bank through China's largest e-commerce platform, crashed this morning. Severe congestion. Users unable to log in, unable to purchase. The infrastructure buckled, and the reason it buckled matters more than the fact that it did. China holds 336 trillion yuan in domestic savings. That is the number. A meaningful portion of that capital tried to move simultaneously into gold at the open, and the systems built to handle it were simply not designed for what happened this morning. Every major Chinese bank reporting a gold buying rush. Every Chinese gold miner hitting the daily limit up. This is not quiet institutional accumulation. This is not smart money tiptoeing into position. This is a stampede. And here is the detail that should make every Western investor in this space stop and pay close attention. Chinese miners are limit up. Western miners are not following. If you have been watching precious metals markets for any meaningful period of time, you know that historically, miners amplify the move in the underlying metal, sometimes by a factor of 3 to 5 times on a percentage basis. That divergence between Eastern and Western mining stocks right now is either one of the most significant near-term opportunities in this sector, or it is a warning signal that institutional money in Western markets is not yet convinced the breakout is real. Those two possibilities demand very different responses. The ones who do their homework will know which one they're looking at before everyone else figures it out. Now zoom out, because none of what's happening in precious metals makes sense without understanding what is happening to the global energy infrastructure simultaneously. Iran has struck 15 different countries or military installations. That is not a number I'm adding drama to. Count them. Israel, the United States, the UAE, Saudi Arabia, Qatar, Kuwait, Jordan, Iraq, Bahrain, Oman, Syria, Cyprus, plus French, Italian, and British military positions. 15. This is not a contained regional skirmish anymore. This is a multi-front military engagement targeting the most critical energy infrastructure on the planet at the same time. Saudi Arabia's Ras Tanura complex, the largest oil refinery in the kingdom, processing 550,000 barrels of crude per day, has halted operations following an Iranian drone strike. At the same time, Iranian drones struck Qatar's Ras Laffan energy complex, one of the most consequential pieces of liquefied natural gas infrastructure in existence. Qatar Energy has stopped LNG production. Qatar accounts for roughly 18 to 20% of global liquefied natural gas supply. Not reduced, stopped. European natural gas prices exploded 47% in a single trading day, the largest one-day move since Russia invaded Ukraine in 2022. That is not a glitch in the data. That is a market pricing in genuine supply terror in real time. Kuwaiti air defenses shot down 3 U.S. F-15E fighter jets. The United States has canceled 41% of all scheduled Middle East flights. And the President of the United States stated publicly, without editorial framing, without ambiguity, "We haven't even started. The big one is coming soon." So you have the largest Saudi refinery offline. Qatar's LNG production halted. The Strait of Hormuz functionally frozen as detailed in yesterday's video. 15 countries engaged simultaneously, and the U.S. president signaling that what has happened so far is the prelude, not the event itself. By any traditional reading of markets, by any framework connecting supply disruption to price discovery, oil should be spiking to levels we haven't seen in years. And here is where today delivers its most uncomfortable data point. 30% of global oil supply is effectively offline or frozen right now, and oil is going down. Oil gapped higher 8 to 9% at the open and is now fading. It has drifted from 73 all the way down to 70. Something is working very hard to hold that number down despite everything physically happening in the world above the surface of the chart. Mark Douglas wrote in Trading in the Zone about the distinction between what the market should do based on fundamentals and what it actually does based on positioning and control. What you are watching in oil right now is that lesson playing out in live action. The paper short stack is doing exactly what concentrated short positioning always does when physical reality starts building pressure underneath it. It is buying time. It is managing the narrative. And the gap between where the paper price is printing and where the physical reality demands it should be is not closing. It is widening. This connects directly to something I covered in the last video, and it is worth saying plainly again. Paper markets and physical reality are separating. We saw it in silver's weekend premiums running 7 to 8 points above Western spot, while COMEX was dark. We are seeing it in oil's price suppression, despite a catastrophic simultaneous supply shock across multiple producing nations. We are seeing it in Chinese physical gold stores, literally running out of investment bars, while Western spot prints 5,346. The distance between these two versions of reality, the paper version and the physical version, is the single most important variable in precious metals right now. Because the history of that gap is not that paper wins. The history of that gap is that paper eventually gets dragged toward physical. The question is timing. And the question of timing is where intellectual honesty demands we slow down. Now let's get into specifically what happened to silver this morning, because gold and silver diverged dramatically at the New York Open, and understanding why is critical for how you think about positioning right now. Gold is up on the day, silver got slammed, At the New York Open, silver was pushed below 90 aggressively before the full session even started. There are two explanations for this, and both deserve honest treatment, because one of them is textbook macro and one of them is something else. The textbook explanation first. This is a supply shock event, not a demand boom. A sudden catastrophic supply disruption creates a growth scare. When growth fear is the dominant regime, industrial metals take the hit. Silver carries approximately 50 to 60% of its total demand from industrial applications. Solar panels, electric vehicles, electronics, artificial intelligence infrastructure, defense manufacturing. When the market suddenly prices in the possibility that global energy disruption of this scale will hit industrial output projections, it hits silver's demand story directly. Gold does not have that problem. Gold is purely monetary. No factory requires it to operate. No panel needs it to generate power. In this regime, gold leads and silver lags. The order is always the same. Gold first, then silver, then platinum, then copper. The more industrial the metal, the harder it struggles until growth uncertainty clears. I told you this was a possibility in the last video. I specifically said gold may lead the next move in precious metals given the safe haven flow dynamics we are watching. That is not hindsight. That is documented in yesterday's video. Anyone who wants to verify that can go back and watch it. But a 7 to 8% dump from highs in under 2 hours concentrated right before the New York Open is not purely textbook. That has the fingerprints of something else on it as well. When silver closed at 94 last session, sentiment across this space went vertical. Everyone was calling for a straight line to 100. Maximum bullish crowding at exactly the wrong point. And I covered this. I said specifically that when sentiment peaks like that after a 5 to 10% move, the market does not reward the crowd. It punishes it. What we saw this morning is the exact mechanism I described. A flush sharp enough to shake out every late entry, reset retail conviction, and leave the people who came in expecting a straight line to all-time highs wondering what went wrong. Sentiment is a weapon when you have size. The crowd provides the liquidity, and the algos extract it. Which brings us to something that deserves direct attention. Who is the largest holder of SLV right now? Jane Street, a $1.3 billion position. I have covered this across multiple recent videos in detail. If you're new here, the full breakdown is available. Go back and watch it. But in the context of today's price action, here is what matters. Do not mistake size for direction. This is not about whether Jane Street is bullish or bearish on silver as an asset. It is about control. When institutional quants accumulate a position of that magnitude, they are not passive holders sitting and waiting for the fundamental thesis to play out. They are there to extract edge, and their edge comes directly from your reaction to the moves they manufacture. The algo is built for exactly the sequence you watched this morning. Pump hard enough to pull retail in at resistance. Dump fast enough to shake them out at support. Rinse, repeat. They profit from your chaos. You profit from their predictability. Those are two completely different games being played on the same chart. The question is which game you're sitting in. Here's what you should be watching right now if you want a technical framework for the next move. Pull up the hourly silver chart. Add the 150 exponential moving average. When silver got slammed to 88 at the New York Open, that is exactly where it found support. Right on that level. It has since bounced back to 90. That level is critical. If silver loses the 150 EMA on the hourly and fails to reclaim it, the next target is 84.9. Possibly lower. That is a number that will flush a significant number of retail participants who came into this position expecting a straight line to 100. They will panic. They will sell. And whoever absorbs that selling will have a position built at a price they were not able to access during the run-up. But here is what the premium data says right now. Shanghai spot silver is sitting at 102. Western spot at 90. That is a $12 premium still intact, even after the Western Open slam. Shanghai futures at 105. The premium survived the New York attack. That matters more than it might appear at first glance. When Western paper price goes down and the Eastern premium holds its level, it means physical demand in Asia has not responded to the paper price move at all. The buyers in Shanghai did not look at Western spot and decide to reduce their bids. The premium between East and West stayed roughly stable through the entire 8% dump. That tells you something important about where the real conviction sits in this market right now, and it does not sit in New York. Now the resistance case, because intellectual honesty is not optional when the stakes are real money. Silver dropped 8% from its highs in under 2 hours. That is not a minor technical setback. That is a significant break that can extend lower if the 150 EMA on the hourly does not hold. Gap fills are real. We gapped up at the open and partially filled back. If silver cannot reclaim and hold the 150 EMA, 84.9 is the next significant level, and there is limited technical support between here and there. The gap fill thesis is a real risk that anyone positioned long needs to acknowledge honestly. Western mining stocks are not following Chinese miners to the upside. Chinese miners limit up, while Western miners sit flat is either a divergence about to resolve violently to the upside, or it is institutional money in Western markets telling you they are not yet convinced. Experienced traders know which of those resolutions has happened more often historically. The structural silver deficit, 10 consecutive monthly green closes before this week, does not guarantee short-term price support. Deficits can coexist with paper price suppression for longer than most retail participants, can remain solvent holding leveraged positions. If you are using leverage here, the resistance case is not a footnote. It is the primary risk management framework you need to be operating inside of. These risks are real. They deserve the same honest treatment as the bull case. Anyone who tells you the upside is certain and the downside is negligible is selling you something. And yet, China had a physical gold buying stampede that crashed its largest e-commerce platform this morning. Physical investment bars are sold out at retail stores across the country. 336 trillion yuan in domestic savings is actively looking for a store of value, and gold is where it is pointing right now. The Shanghai premium on silver held at $12 through the entire Western Slam. Physical gold in Chinese retail is trading $1,000 above Western spot because the inventory is gone. Qatar's LNG and Saudi Arabia's largest refinery are simultaneously offline. The structural silver deficit that has been building for years has not changed because of a single session's price action. And the unresolved question sitting over every single one of these data points, the question that connects oil's suppressed price to silver's pre-open dump, to Jane Street's 1.3 billion position, is this. Does informed institutional money know something that has not appeared in the public data yet? And if so, what does the position they are building right now tell us about what they expect to happen next? That question does not have a clean answer today, but the data that surrounds it is not random. Paper is suppressing physical reality across oil, silver, and gold simultaneously during the largest multi-front energy infrastructure attack in modern history. Those three things happening at the same time in the same direction, managed by the same mechanisms, is not coincidence. It is coordination. And the gap between coordinated paper suppression and accelerating physical scarcity has a historical resolution rate of exactly 100%. It always closes. The only variable is when. Subscribe to our only and the official backup channel, OG John AG 2.0. The Middle East situation is moving fast and data is coming in between videos. Check the handle, verify it, everything else is noise. If what you watched today changed how you see this market, share this video with someone who is still reading the surface-level headlines and wondering why prices are not doing what the news says they should. They deserve the actual data. The like helps the algorithm understand this content reaches people who need it. And if you are not subscribed yet, the next video picks up exactly where this one ends. And the next data point coming out of the East may be the one that forces the Western paper market to stop pretending. Drop OG John AG 2.0 in the comments right now. Not because it is a trick or a gimmick, because in a space full of copycats and noise merchants, the people who watch this entire video and can hold the full context in their heads are a specific kind of person. And I want to know how many of you are in this room. The data is the signal. Everything else is a distraction.